Most traders don't lose because they have bad strategy. They lose because they trade without understanding what the market is really doing. And if you keep making the same mistakes, your trading account won't survive for long. Chasing breakouts, buying tops, selling bottom, and becoming the liquidity is the major common issue in the retail trade. But what if you could identify the high probability trades before the big move begins and stop falling into these traps? In this video, I will show you the complete process to identify the perfect trading strategy. There are few steps. Let's break down that. This is the exact framework that helps you trade with confidence instead of emotion. Watch until the end because one small detail in this strategy can completely change the way you look at the market and helps you avoid next unnecessary losing trade. So let's begin. There are four steps to identify the best trading strategy. First, market structure. Second, finding liquidity. Third, finding order block and fair value gap. The last part is the entry part. First, starting with market structure. Before we get started, I highly recommend watching my market structure video on the basics first. I have linked it on the description. If you have already seen it, let's jump right in. Let's start with quick basic overview of market structure. In market structure, we have break of structure and change of character. In break of structure, the price always follows the trend by breaking previous higher highs. In change of character, this is the early sign of trend reversal where the price breaks the previous higher lows or lower high. Now, if we want to enter the trade, all we need is this move. Let's mark it with this. Let's mark it. Now, the next part is marking 50% level zone from Fibonacci retracement. So, this is the 50% zone. This is the basic of market structure, identifying trend, break of structure or change of character, then marking 50% level using Fibonacci retracement. This is the first step. The second part is identifying liquidity. I actually have a deep dive video covering everything you need to know about liquidity, so make sure to check out in the description. In this video, we aren't defining what liquidity is, we are focusing on why the exact location of liquidity matters if you want to catch the best possible entry. Consider this move. On lower time frame, this move looks exactly like this. Here we have two liquidities, one here and another one here. Which one do you think the actual ideal liquidity? This one, right? So most of you got it. Any liquidity present near or above 50% Fibonacci level, then that liquidity is ideal liquidity. If the same liquidity or range, if the same liquidity or range present here on the premium area, I definitely use this zone or range for the sell setup. I mark it here and I will wait the price to come here and then I don't see this as liquidity because this range could be a high time frame supply zone. Are you understanding it? This range could be high time frame supply zone. This liquidity is below the 50% level and this also the below this 50% level, so it's not the premium area to sell. So above 50% level is always the premium area to sell. I hope most of you got it. Moving to next part, identifying order block and fair value gap. Most traders find difficulty to identify order block and fair value gap. For me, this is the only easiest thing to find fair value gap and order block because fair value gap is simply the price displacement on a large scale. We can easily find it. Our eyes always find fair value gap. It is simply the price always displays creating the imbalances. Order block is nothing but a last buying candle, last selling candle before the big institutional selling and buying happens. For me, from the last 5 years, any order block above liquidity, above fair value gap, but in the premium or discounted zone, that is highly anticipating order block to sell setup or buy setup. Don't go for ICT and SMC. They just selling their businesses to you. Just follow these 4 steps. I can guarantee you you could be a profitable in next 6 to 12 months. The last step is entry. Once you identify the order block, just go and enter the trade and put your stop loss above the order block 10 to 20 pips and target it depends on you how much you want. Never ever wait for confirmation. Confirmation itself a trap. You already missed the fresh supply or demand move. Have you ever noticed the unmitigated order block always give fresh 40 to 60 pip move? All you need is just 40 to 60 pip move. Once the fresh move comes, always close half of your position and set the break even, then wait for market to do the rest. If you wait for confirmation, you already entered the trap. You simply wait for confirmation like this and you identify fresh and unmitigated 5 minute or 1 minute order block and you put tight stop loss here. You put you put tight stop loss here. Once failed, now you think this zone hold the potential to reverse and you overtrade, covering your losses. And you, once the price move and take your stop loss, you think this zone hold the potential to reverse. Now the next thing you do is over trading by putting a stop loss, and now also you target the same. Once the price move towards your stop loss, you again you move to margin call. I also experienced the same and entered the confirmation trap for almost 1 to 2 years. Then I started understanding the market, each and every move. I captured each and every move. I understand better and better. Then I implement my own strategy. Again, I am telling you, never, if you see this bearish unmitigated order block, just go and enter, leave, put your stop loss above order block and leave the market. If it hit the stop loss, you just go, don't overtrade, and you don't have the time to overtrade because this move is very slow. If you entered the confirmation trade, then this is very fast move and you put the tight stop loss, you can take a revenge trading over trade by again and again. So if you follow other strategy, in fact mine, all I can say is you are slave to others. Find uniqueness, understand the market day by day, and try to learn the mechanics behind every move. Most institutes hides fundamentals, CFTC COT report, which you are not aware. Everyone wants to open trading view and wants to enter the trade. That's not how the market works. There are settlement periods in the banks, fundamentals, COT reports, relationship between the stock and bond market, and capital super siphon theory. Try to learn a new thing day by day. You will get better on this. If you comment Forex theory, then I try to help you guys with theories other than technical analysis. I hope you enjoyed the video. Thanks for watching until the end. See you soon.